Welcome to the Daily Update, where I'll go over the action in the market for Thursday, April 11th, and then we'll see how things look for Friday, April 12th. We had a pretty nice little bounce. PPI came in weaker than expected. The market liked that. We were able to recoup a lot of the losses that we saw in Wednesday's session. We're still not switching over to positive yet. We are showing an improvement in the short and intermediate term. Long term, we're still positive there. The extreme negative readings that we were getting after Wednesday, those have pretty much all been worked off now. Not all of them, but most of them. And the market is still kind of at a tipping point, but we were able to recapture one of the 20 period moving averages for the S&P, and we're just a little bit below the other one. The mega caps really helped to prop up the market and give the S&P and the Nasdaq 100 some support. So for right now, the market isn't necessarily falling off a cliff at this point. We saw a nice little bounce after the decline that seemed to switch the whole scenario after Wednesday's session. So let's go back and talk about what happened. We did have a lower open. It looked like, okay, we're just going to continue on with the decline that we saw after Wednesday. Prices fell down to S1 at 51.40. That set the low for the day, and we were able to bounce up off of that. So we climbed back above the daily pivot at 51.59. We got above the unchanged level. We got above R1 at 51.80. We got up to R2 at 51.99. Notice we're dealing with that 5,200 level again. And we closed just about at R2 and a few ticks right under 5,200. So we were up 0.74%. We recaptured a lot of the loss that we saw in Wednesday's session. Volume was still below average, though. That's what we've been seeing. We saw that one above average volume day a week ago Thursday when there was a real decline. Other than that, volume has been below average for the last number of weeks. Longer term, we're still positive. We're a little bit more vulnerable in the short and intermediate term. I'll go through the charts and show you what I'm seeing right now. And it's about inflation and interest rates. Inflation was seen as more negative when CPI came out. That drove things lower. PPI was taken as more friendly. That helped to see parts of the area show a rebound in Thursday's session. We want to keep an eye on all the different geopolitical things right now. There seems to be a lot of things happening, but nothing that's really impacting the market. Of course, at any given time, things can escalate, and that can turn into a full-blown situation that the market does react to. Some comments. PPI did come in weaker than expected. The mega caps and the semiconductors, they had solid days, and that helped areas of the market where the mega caps reside. And growth is outperforming value. We're seeing that really switching over again. If we're going back to this environment where it looks like, okay, interest rates and inflation are still a problem, now we want to keep a closer eye on growth versus value, where it looked like we had been switching over to where, okay, growth can do well, value can do well, commodities can do well, inflation can do well, because inflation's going down overall and interest rates are probably going to go down. We're kind of putting that on hold for right now, or at least the market is possibly transitioning from that. Oil, it actually declined. It came down to $85. I should have changed that to declined. We just have one of our PMO studies that are looking extreme negative. Everything else that was on this list for yesterday's video is now off. Long term, though, we're still showing what you could say is good momentum with the 150 and 200 period moving averages, but they're also extreme at the same time. And we're still wondering, where are we in the midst of this whole scenario? It does look like the Fed is likely done raising rates unless we see a string of stronger than expected economic reports. And now they were thinking we might have 3 rate cuts in 2024. That's in doubt right now. Are there going to be any rate cuts in 2024? So that's the part of the game and the things that we try to figure out each day as the market's trying to figure that out as well. The dollar was up and interest rates were up. We still see interest rates going back up now. We closed at 4.58% for the 10-year yield. We're still inverted with the yield curves. With the up day, we ticked back over into the positive area as far as sentiment is concerned. We had been more neutral at 54. We closed at 58. After Thursday, we're still not trending. The ADX is not crossed above the moving average, either in the short or intermediate term. If anything, we would default to negative because the red line is still on top. And I should have changed the bias over to positive since we had the update. I'm still keeping the longer term momentum at mixed to negative because we're seeing a real shift right now. We got the weekly initial claims that came out at 211,000, less than the 218,000 they had expected. This is still showing that there's some strength in the employment situation. Last week we had 222,000. Continuing claims ticked up a little bit to 1.817 million. Last week it was 1.789 million. Here's the big one. PPI came in weaker than expected at 0.2% of a rise. They expected it to be up 0.3%, and last time it was up 0.6%. The core, this is the inflationary part, it came in as expected, being up 0.2%, and it was down from the 0.3% we saw last time. So here's some charts. Here's the total, which is the blue line. It is going back up when you look at this overall, and the core rate. This is the inflation part. It's also starting to go back up. But because it was weaker than what the market had been expecting, they took that as positive news. Then you look at final demand goods. That's the blue line here, which they're going up, and we're also seeing an increase in services. And then intermediate term goods, processed and unprocessed goods, they're both continuing to go up. Here's our chart of PPI. When you look at it on a year-over-year basis, it's now starting to go back up. But when you look at it on a month-over-month basis, it did decline. Here's the core PPI, where it's declining on a year-over-year basis. This is the inflationary part, and it's also declining on a month-over-month basis. So the market liked that part. Because first it comes through to PPI, that's producer price index, the things that companies buy to make things, and then it ultimately goes over into CPI. So if we see PPI being more friendly, the logic, which may be realistic or not, is that it will eventually go over into CPI. Here are the weekly jobless claims, where they dropped off and we're starting to flatten out a little bit with our 4-week moving average. We went up with the continuing claims and we're flat to slightly going up here as well. But we're not seeing anything drastically to the upside or the downside on these with these weekly reports. So it's kind of being stable right now. And then just to put it all together, here's the longer term chart. The red line are the initial claims. Then we have the continuing claims in blue. And then we had the unemployment rate, which came out a week ago. And just to give you a better look at this on a shorter term horizon, just to see how they look graphically. Then here are some Isabel Net blog charts. Now this is margin debt, and there can be some lag in this. Margin is when you borrow money to buy stocks, at least in this context. And when folks are more optimistic about the market, they're willing to borrow more. Now, if you borrow $10,000 from your broker and the stock goes down and you get $12,000 back, you sell it maybe at a loss at some point in the future, you still have to pay that full $10,000 back. It's not like you have a 50-50 relationship with your broker. Everything that you borrowed, you have to pay that all back. And so in more positive environments, hey, it's a 2-for-1 type of a thing because the margin rate's at 50%. And so when we see margin really going up, that means folks are willing to take on more risk. And that's what we're seeing right now as the balances are going back up. Notice in 2022, when we were going down, we saw margin debt decline. Well, with the market going back up, we're seeing margin increase. And it's a normal thing. And it's been a while since I've opened a new brokerage account, but usually when you establish an account with any different brokerage, it's usually a margin account by default. You actually have to go in and tell them, I want this to be a cash account. So be aware of that. And a lot of times, if you do option strategies, you also have to have a margin account as well, even though you use all cash to do your options transactions. And the volatility is the toll that we pay to invest. And this just looks at, okay, what are the chances or what happens when we have a 3% dip? Now we haven't had that yet, but of course this is smaller, so we see that more often. And then 5% mild correction, 10%, that's what the definition of a correction is. We get down to 15%, 20%, and this is more or less what we went through in 2022. And then we've been bouncing up out of in 2023. Then here's mega cap growth in tech, where we've been seeing a lot of people getting into this, and lately it's been pulling back. But we saw a really nice day on Thursday for these areas of the market. But this is still the favored area for most investors. And then gold, not as shiny as you may think. This just means that, okay, gold, it may be giving a pretty good return here. We're up 4.5%, but there's a lot of volatility with gold. And where there's volatility with stocks, this is how we make money, especially if you do a lot of options types of strategies. And volatility, this is also on a world basis, but just showing on a rational basis, when you look at them relational, that's what I was trying to say here. Gold ends up being a lot more volatile. Now, it doesn't really say here if this is the ETF, because futures contracts, yeah, they're really volatile because they're so highly leveraged. But it just shows that it bounces around quite a bit. But that's what a lot of folks are talking about right now, since gold seems to be the thing. These are the money market chart here, just to show you how money's been going into this. And I always like to point this out. Yeah, this is looking positive, and folks are getting into this because it's a more attractive yield that they're getting compared to what they would be getting at their banks. Financial conditions does show that it's loosening a little bit, and that has been giving some support to the stock market. Then we look at earnings sentiment, where the dark blue line here, this is the S&P 500. It's coming down a little bit, but it tends to be doing quite well. And then just compared with different areas of the world, are earnings going to go up or are earnings going to go down? This is how folks are feeling about things. I didn't really find anything on Twitter. We're still wondering about this cycles chart where we seem to have declined, but now we're bouncing back up. We'll just see if we kind of stick to this going forward. Here's our intraday chart where it did look like, okay, maybe we're going to go down a little bit here. We didn't see much of a gap at the open, but we came all the way down to S1. We didn't exceed the previous day's low that we saw on Wednesday. So we held at a pivot level. We also held at a previous low, and then we came up off of that. We were able to go back above the daily pivot. We switched positive. We got above S1, S2, and then closed down just about at S2, slightly under 5,200. Intraday, where we were more negative before the market opened, and then PPI came out, and that's what gave a boost to things. But we still saw more of a negative open, and then it was later on that we saw stocks reacting more positively to that. Not much of a change in the initial overnight session. This is where we're seeing more of a shift, and this is actually looking a little more positive under the surface. We see the blue line above the red line intraday. That means that growth is outperforming value. We saw this ratio really going up. When we do a ratio between growth and value for the S&P, that's also looking more positive. And then our end of day charts, growth was up where value was down for the large caps. It was up where it was down for the mid caps, and up more for the small caps than it was for small cap value. So we are seeing a bit of a bounce here with small cap growth to value. If we're switching back to that kind of an environment now, we also turned up with mid cap growth to value and S&P growth to value. So this is looking a little better. We're not really seeing any improvement here with discretionary to staples. That ratio is still more or less chopping sideways, even though it's still in a longer term uptrend. Large cap growth was up over 1.5% and is above all the moving averages. So this is where we saw a lot of the strength from. And when we look at the large caps versus the small caps, we came up here just a little bit, and we are showing a bit of an outperformance on this chart. But when we look at our trend, the red line, even though it's declining, is still on top. That means we default to positive. We're dropping below 20 with the ADX, and we're below the moving average. So we're in a trendless environment, which right now, if we do pick up with downside momentum, it looks like that trend could in fact be negative. Now we could shift over and maybe go trendless for a while longer and switch back over to a positive stance, but we don't know if that's what's going to happen. We're seeing a little bit of a turn up here with the short term, but we're still below the moving average. The red line is still on top, even though it's declining. And we continue to be below average with volume. Sentiment, this came out a couple of days ago. It did drop from a really high reading, but it's still giving us quite a high reading, up over 4. The Ulcer Index continues to go up, and we're coming up to the moving average, suggesting there's more fear coming into the market. But with the up day, we decline with the VIX when we look at the line chart as well as the bar chart. And you can see this bar was quite wide. Didn't see much of a change from close to close here, but there was a lot of volatility inside of the day. And with the update, the VIX of the VIX did decline, both with the bar chart and the line chart, but we're still well above these moving averages. The momentum for the MACD continues to be up, and that just means there's more fear in the market. And we're still not getting updated here with the equity put call. So I don't really know what to tell you there. It's just not updating right now. We had the latest reading from the American Association of Individual Investors. They dropped off a little bit, so they're not extreme positive, but the 50-period moving average continues to go up, showing that that is more or less positive. And we went back up here with the volatility risk premium. It's kind of strange. It went down on a down day and now up on an up day. Usually they tend to move more in opposite directions, just showing that volatility is picking up here. With the advanced decline line studies, we still declined when we look at the advanced decline line based on price and volume. So this was mostly mega caps and really big companies and the semiconductors. We didn't see an awful lot of strength inside of the market. So we're continuing to decline with our 5-period. We saw a little bit of growth in the new highs, not much of a growth in the new lows, but we're continuing to decline with the 10-period as well. We're still below zero here when we look at the shorter term 19-day exponential moving average of the advanced decline ratio. We're still positive with the longer term 39-day exponential moving average. And we saw a little bit of a tick up above the moving average here with accumulation distribution, showing a little bit of an improvement there. We're still chopping sideways, but negative with the Chaikin money flow. And believe it or not, the Chaikin oscillator has actually crossed over positive. So we're still seeing more weakness here with the NYSE cumulative advanced decline line. It still is going down. With the regular advanced decline line, this also declined. And our other NYSE advanced decline line also declined as well. When we look at common stock, it was down on the NYSE, both based on price and volume. And we were down when we look at the cumulative S&P 500 price, that declined as well as volume. So this wasn't a broad market bounce here. This was led by a few stocks. We're still above zero here with our NYSE new highs minus the new lows. Now, the red line, that's the 50-period moving average. That's still positive. What we're watching right now is this black line, and it had dropped slightly negative, where still it's continuing to be positive after Thursday's session. So a little bit of a turn up with the NYSE common stock with our advanced decline line studies, flat with the S&P, slight increase with the mid caps, and we saw a bit of a bounce here with the small caps. Here is our chart where we're coming back up to the pivot point now, and we're still above the 50-period moving average. Down below, we are below average with volume. We were able to get above the the exponential moving average here. That's the blue line. And we're right about on the simple moving average here. So we're kind of in between the two. But the fact that we were able to recapture this is positive in and of itself. And we're coming back up into the middle part of the mini rainbow here. That's showing a little bit of an improvement. And we want to keep an eye on the 50-period moving averages just in case we see more weakness. And we're still below the double and triple exponential moving averages based on 20 periods. And the lines continue to decline now. So we ticked up barely with the 20. We actually are still declining with the 50. And we also declined with the 200-period exponential moving average steady. We're coming right about up to the midpoint, but slightly negative with the force index. We're no longer extreme in the short-term stochastic. We're still declining in the intermediate and long-term. And with our standard deviations chart, we were able to get back above the midpoint. That's slightly more positive. Intermediate term, we're bouncing up, but still negative with the balance of power. The go, no-go is still the lighter shade of blue. and we're just a little bit above the midpoint between our highest high and lowest low value. But now the midpoint is starting to flatten out. TTM squeeze continues to decline. It ticked up just a little bit, but with the darker blue, that's more negative. And with our 50-period exponential moving average, looking at the double and triple studies here, the red line is starting to cross down below the blue line. So that just means that some weakness can be coming into the intermediate term trend. The Bollinger Bands, we were able to get right back up to the midpoint, and we're right on the midpoint as measured by the percent B. Equi-volume ticked up slightly, but it's still negative. The Arun finally woke up and actually declined a little bit, even though it's still positive, because the green line is on top, but is declining. We're seeing the red line picking up. That's why we saw a decline with our oscillator. And we're still negative with the S&P McClellan oscillator. We ticked down just a little bit. We're not extreme, but we're below zero. So we're seeing our summation index based on price and volume continue to decline. We're also ticking up a little bit with the NYSE McClellan oscillator, but still below zero. So we're declining with the summation index for the NYSE based on price and volume. We ticked up, but we're still negative with the Swenlin trading oscillator. On a momentum basis, we're still negative with the PMO based on price and volume. We're still extreme with the PMOs that are rising, even though it ticked up. We're declining with the buy signals, and now we're rolling over a bit more with the PMOs above zero. We switched back over to positive for the Elders Impulse System for the S&P. We're still negative with the parabolic SAR. Momentum for the slope continues to be negative. The MACD continues to be negative. All of our oscillators across the different time frames are still negative. We're battling right here at the 20-period moving average. We still are declining with the bullish percent index. We dropped below 70 and we're continuing to fall here. So we didn't see a bounce here. We're also declining with the NYSE bullish percent index, but we're still above 50. And we're still below 50 with the NASDAQ 100 bullish percent index, even though it ticked up slightly. We're below 50 and declining with the money flow. We turned up, but we're still below 50 with the ultimate oscillator. We're now negative for the second day here with the vortex. The green line crossed below the red line. We bounced up a little bit off this 50 area with the RSI 14, and we're just a little bit above 50 with the RSI 9. If we can get back up into these plus 50 areas and stay there, that suggests better momentum. We're still above the moving average with on-balance volume. We're below 50 when we look at the stocks inside the S&P above their 20-day moving averages, and that's still declining slightly. We're also declining with the 50-period moving average study and still declining with the 100 as well as the 200-period moving average studies. The Copic curve is still negative. The Sean trend meter ticked up, but we're not extreme right now. We want to keep an eye on these possible fib levels if we see more weakness. Then when we look at the trend with the Heiken Ashi, this is more of a doji where we opened and closed just about at the same spot. We're negative with the Kegi, but now pointing up. We're still positive with the Renko. We're still negative with the three-line break. And we're still above this R1 level here. We haven't really even tested that with any real severity, at least yet. A test may be in the near future. We'll have to see how things play out. We're still extreme, but coming down with our 150 and 200 period moving averages. And we've changed back a little more positive. Stocks are positive across the board, where you have mid caps remaining negative and the small caps are negative in the short term. And bonds continue to be negative based on price, and commodities are negative in the long term as well. And we started off by seeing some negative things, and then we saw positive things later on, mainly to do with the NASDAQ and S&P 500, because those are where the mega caps really reside. The equal weight underperformed. We saw a real spike up here when we look at our ratio. This just means that the big stocks really outperformed the rest of the market. The Dow continues to look a little bit weaker. It was virtually unchanged, but down slightly. We're below the 50-day moving average. The diamonds continue to be negative. And we saw a nice little spike up here with the NASDAQ. We were able to get above and close above this pivot point. Now we're still kind of going sideways overall. We want to see if we can break out of this range that we've been in. And the NASDAQ 100 also closed near the high above the midpoint, but has been really chopping sideways lately. and the 50-period moving average has held for now. And we turned back over to positive with the QQQs with the Elder's Impulse system. But the momentum for the NASDAQ 100 is still negative. And we're above the 20-period moving average. The 50 held as support. So this is showing some improvement. Small caps were up a little bit less than 0.5%, but still just more or less going sideways, still below their 50-day moving average. They continue to be negative with the Elder's Impulse system for the small caps. We're below 50, but turning up with the Russell 2000 small caps. When we look at the RSI, we're right back at the 50-day moving average. We're still in a longer-term uptrend, but the momentum continues to be negative. The mid caps are still above this S1 level and above their 50-period moving average, and the longer-term trend is still positive. But they still remain negative according to the Elder's Impulse system when looking at the mid caps. Apple was up over 4%, but still in a longer-term downtrend. Tesla was up as well, but also in a downtrend, where NVIDIA ended up being up, and it kind of came close down to this 50-day moving average. Maybe it'll get a little bit of a bounce up off of that. The FANG index finally broke out of this range that we've been going in for quite a while now. At least we're coming up, and it looks like it could be a breakout. Now we'll watch this to see if it ends up being a fake out. Financial sector seeing a little bit of weakness here, coming down to its 50-day moving average. We're going to have banks coming out with their earnings in Friday's session. We'll have to see if that's going to bleed over into the financial sector, bouncing back or turning more negative. The dollar continues to go up and is well into the 105 range, which could be pressuring stocks. Here's a longer-term look showing how we're breaking out of this, above this longer-term downward sloping trend line. Oil did fall back a little bit into the 85 area. And again, there is a delay here when we look at the S&P, the red line, when we compare it to the world index, where we're seeing a little bit of an improvement with the short-term relationship, but it's still declining in the longer term. We did continue to go up with the 10-year yield, so we're continuing to fall below the 200-day moving average based on price for the 10-year. And then this is where we're seeing some improvement as well. The Qs to S&P actually crossing above the moving average. Discretionary to the S&P, that turned down. When we compare large cap growth to large cap value, breaking out above the moving average. So we're seeing an improvement with the large caps, mid caps, and slightly with the small caps. All of them are above their moving average now, but we want to see some follow through here. And we're still coming down with our 10-day average of the S&P 500 highs minus the lows after being extreme positive for most of 2024. We're still just a little bit negative with our 19-day exponential moving average of the advanced decline ratio. That's what I showed earlier in the video with the blue and the red line. We're still below zero here. We're slightly turning more positive when we look at this based on volume. And we're continuing to decline with the Staples to S&P 500 ratio, which often gives support to the S&P, but hasn't been helping lately. So what's our outlook for Friday? Earnings season will begin. Banks are going to be coming out. That's probably going to be a real driving force in Friday's session. Longer term, we're still positive with our technicals, with the short and intermediate term showing some improvement, not a lot, but some improvement after being really weak in Wednesday's session. But you can see as we look at the charts, it wasn't broad-based with the bounce that we saw. We're going to get import and export prices as well as consumer sentiment. And then we want to keep an eye on all the geopolitical things. Here's consumer sentiment in Friday's session. Nothing marked here. It's not marked as major. When I post this chart, I just do the things that are 3 stars. Seasonally, we're positive with the Dow and S&P, where we're neutral to negative with the NASDAQ for April 12th. We do see some negativity here during an election year for the S&P. We see the green dashed line actually going down slightly. And then comparing it to the pink or purple line, we might see some weakness here if we compare it to the other first quarter that was really strong. Not sure where we are with this chart. Friday tends to be the second most positive day of the week, followed by the upcoming Monday. And we might see historically a little bit of weakness ahead of tax day before we see some strength going into the latter part of April. And this has come down just a little bit the year to date when we compare it to election versus non-election years. April is one of the stronger months. On a global basis, it is the strongest month. It's also strong when you calculate this looking at different factors. And then this will probably be the last time I show this for April. I'll switch it over to the weekly video where we're up 11 out of 18 times and down 7 out of 18 times. I'm also going to move this chart where we're up 71.6% of the time with an average return of 1.5%. Tom Bowley still suggesting that we're in that stronger period for right now before we see some weakness and then finish off the month stronger. Warning signs. I don't know about the equity put call ratio. It just didn't update there. The parabolic SAR, though, is still negative. We're still below 70 with the S&P bullish percent index and continuing to decline. And we're still below 50 with the NASDAQ 100 bullish percent index. That's negative. The Chaikin money flow is negative. The ultimate oscillator and the Kopic curve, those are all negative. The vortex is also negative. And our oscillators are declining after giving us extreme positive readings. We do have some negative divergences between the small caps and the S&P. The ratio between discretionary and staples and transports, when we look at them compared to the Dow and S&P, and the momentum for the NASDAQ 100 is still negative. Positive signs. We're back at the 20-period moving averages. We haven't really cleared them, especially the simple moving averages, but the fact that we're even close to them after what we saw in Wednesday's session can be taken as positive. The Chaikin oscillator has turned back positive now, and the NASDAQ 100 is still above its 50-period simple moving average. The growth to value ratios that we're following are showing some improvement. Large cap growth is still holding up fairly well. Also, in the financial sector, even though it's seeing some weakness, it continues to be positive. We'll have to see. Is this one of those sell the rumor, buy the news? Usually it's the other way around, where you buy the rumor, sell the news. We saw that earlier in the week where they were doing a lot of front running. We'll see what happens in Friday's session there. So we're positive in the bigger picture. We're seeing weakness in the short and intermediate term that as of right now could be showing us some signs of improving, but it's not broad-based. In the short term, we're negative, but possibly showing some improvement. Intermediate term, also showing some improvement. We're still positive in the long term. Thank you. I hope you have a really good day. I will be preparing the videos over the weekend, so have a great day on Friday, and I'll talk to you in the next video.